A company can do one of three things with the cash it generates. Firstly, invest for growth. Secondly, pay down debt. And lastly, the focus of our yielding products, return it to shareholders. High Street does this by prioritizing defensive investments producing significant cash flows to return to shareholders. We consider these returns to comprise the yield generated by dividends as well as the buying back of their own stock. Global equity market returns, as proxied here by the MSCI All Country World Index, generated an annual return of 8% over the 20-year period ending December 2021. Drilling down into the composition of returns, one might be surprised to observe that the capital growth portion accounted for less than half of the total gain. The yield generated from share buybacks and dividends accounted for the lion's share at 28 and 26% respectively. The yielding products focus on the cash returned to shareholders by investing in high-yielding assets, providing a consistent income stream supplemented by the potential for moderate capital growth. Combined, we believe this can offer investors a relatively stable return profile while still seeking long-term gains similar to that of general equity markets. This strategy is offered through a leveraged and unleveraged structured product. Over recent history, the yield available from dividends and buybacks on global equities exceeded borrowing costs by a meaningful margin. Investors who believe the situation is likely to persist can utilize leverage to amplify returns. However, investors must be aware of the risks involved as leverage amplifies both upside and downside performance.